Hello again everyone, dear viewers. In this lesson we will look at such aspect of smart money as fair value gap. What is fair value gap? As uneven price distributions on the chart, where funds have let go of the price and will return to this range to build up their position and let go of the price in the opposite direction. So how do you identify fair value gap on the chart? You now see two examples of FVG on the screen, a bear FVG and a bull. To determine the FVG, you need to select the area from the low of the first candle to the high of the third candle, like this. This is the zone of our FVG. FVG is used as one of the factors to enter a trade. This range will consider formations for entering a trade on lower time frames. To go to a lower time frame on the TradingView website, there is a tab with different time frames. If we look at the daily time frame, we go to the 4-hour, hour or minute time frame and look at the formations there. To fully validate our trade, we need to look at all time frames, but the bigger it is, the more valid it is. But the most important thing to remember is that the price is fractal and moves according to the same laws on any time frame. The main method of working of FVG is to fill it. After filling the inefficiency, the price is likely to turn around. Based on this, we will enter the deal. Now I will give an example of filling FVG. Here is an example of filling a bearish FVG. The price returns to the zone, banks or funds gain their positions, and after that the price goes down. We look at our formations on all time frames, and based on that we should go short. This is the most likely scenario. For example, it will be like this. The price will continue to fall down until the first liquidity is removed. After that, we will wait for new formations. As an example of a trade, in this situation, we could open a short position from 50% of imbalance filling. 50% is determined by the Fibonacci grid. And from the value of 0.5 we can open a trade with a stop loss for the upper boundary of the FVG. This is a risky stop loss. A more conservative one can be placed behind the high of the first candle. Let's consider an example on a bullish FVG. Who does not know, bullish FVG is in long, green candles after which the price will turn upwards, and a bearish is red candlesticks and the price will turn down. The bullish FVG is determined in the same way from the candlestick borders. It's also worth mentioning that once the FVG is filled, it ceases to be valid. That is, next time the price will not get any reaction from it. But my point is that the price will always revert to inefficient pricing. If there is a FVG left on the chart, sooner or later it will be filled. In this video tutorial, we only look at FVG, without delving into other aspects of the smart money. But it is worth saying that liquidity and FVG are two of the main aspects of the smart money. They are the ones that affects everything. Also, to enter a trade correctly from FVG, you need to take into account the trend. The most important rule, never trade against the trend, in order not to lose your entire deposit. Trade only when you are completely confident in your actions. In trading a huge role in your psychology. You must sit at the chart, open trades and wait with a cool head. So, let's take a look at an example of a pattern to work off FVG, which has a 70% probability of success. You can look and find many similar cases on the charts and work them out on the backtest. Before trading a real account, spend a lot of time on the backtest. Don't repeat my mistakes. Backtest is all for traders. So, this situation we see when FVG was filled after the withdrawal of liquidity of the LOI, which gives us confidence. What price is now collecting positions from the tops and going down. So the development of this situation in this scenario will be as follows. The price removes the liquidity, fills the FVG and goes down. And one more, by the way, variant of opening a deal and stop losses is at the beginning of imbalance and stop for imbalance. Take profit for the first liquidity pool. This is the most profitable option, but not the safest. Also, I showed the entry from 50%, which we estimate by Fibonacci grid, and the safest option is for the outermost candle. The takeout of our trade will be at the end of the imbalance. Take profit behind the top candle and stop loss by the liquidity pool. The bullish FVG works exactly the same way. That is, there is no difference whether the imbalance is bullish or bearish. The most important thing, guys, is to take into account the context of the trade, the trend and liquidity. So let's summarize all of the above. What is imbalance? Imbalance is inefficient pricing. So how is defined on the chart? The chart shows the low of the first candle and the high of the third candle. Our PVG zone ceases to be valid once it's completely filled. That is, when the price will not rise from it. Bear PVG and bullish have no difference, only in the direction of price. A bullish is up, a bearish is down. By the way, a bullish PVG has also formed on this example, but we won't go in from it, because the context of this trade is what the price is going downtrend. Also, in order to consolidate the material of this lesson, draw the pattern what I have shown on this chart. Let's move on the real chart examples in order to consolidate the material. So, here we come to the real chart, where I have highlighted a couple of imbalance zones. But as you can see, they don't work. Answer in the comments why. And so, why aren't they working? Because the price on the daily time frame is going downward. That is, here we had a breakdown of the local trend, but still the fundamental trend is now downward direction. By the way, it is worth mentioning what there is a subtrend, the real trend. A subtrend is something what is inside a micro trend. For example, there is an upward movement here or a downward movement here. A regular trend is a fundamental trend, is a fundamental movement. Here we can see a given FVG zone from which opening trades in short even from 50%, and putting a stop over the end of the FVG we could get a 10-to-1 trade. It will be a great trade if you didn't make it. And you can find the same hundreds of examples on the backtest before you start trading. Let's move on to another cryptocurrency. Here, for example, is my chart of Ethereum, which I analyzed back at the beginning of this move. Here I had a FVG allocated, which successfully worked out. If we put conservative stops here, for example here, and on top liquidity withdrawal as a reminder trades, as a reminder, these are on the daily time frame, meaning we have a high chance of working out if we have considered all aspects. Let's look at examples on the Ether only on the lower frame. Looking briefly, we see this filled balance. I remind you, what if the balance is filled, the price does not return. Here we could open a trade with a safe stop. Before the liquidity we see is removed. There is nothing on the left side of the chart. Here's a trade what has ratio of 2, almost 1 to 3. I am trading at 2% risk, so I will have a 2 to 6 ratio. If we do a detailed analysis of this trade, we see an uptrend for a long time, and it's impulsive. That is, the price is not going to retrace. By the way, on the chart we can notice this unfilled FVG, to which the price will definitely have go. Let's look at in more detail. We have an uptrend and we have pools of liquidity, what have not been withdrawn. Right here at the top, price is going from liquidity to liquidity, from FVG to FVG, so we have a sideways move here. This, by the way, is one of the forms of sideways trading. If there is a FVG at the bottom, or if there is FVG at the top, the price will tend to fill it. A lot liquidity is formed in a side wall, that is, having collected this liquidity, moving away from the FVG, the deal we will close in plus in 100%. You can also examine the deal against the trend, but I repeat, So here on the chart we see the formation of VWG, which we highlight. Based on this VWG we can enter the trade, but our stop will be long. With one of the disadvantages of this trade, well, we see an unfilled imbalance at the bottom, where the price will tend to go, and we can put a takeout to it, counting on the fact what we know, what the price goes from imbalance to imbalance, from liquidity to liquidity. At the bottom we have some liquidity not withdrawn, which the price will try to get. With it, we can watch our trade play out. Taking our take, in this range it was already possible to close the deal in plus and transfer stop loss without loss. We had sit on the deal for a long time, but the reward is 1 to 5. The deal worked out. On withdrawal of this liquidity, it was possible to put a fixation of 50 or 70% and transfer stop loss to not loss. If the stop loss was transferred to not loss, it would close it, but that's okay. The main thing is to fix the profit. Okay, now let's look at the last example before the end the lesson. Here we see a balance sheet what is already filled out. Now this imbalance sheet here is not filled, no one has touched it. You could say it wasn't fulfilled. Here we make an VWG, we open a trade from 50%, put stop loss safe, conservative and liquidity capture. We open a trade from 50%, put stop loss safe, conservatives and for liquidity withdrawal. We can't see it on the left, but we can put it like this, and we'll be able a 5-to-1 trade.
So here we go, dear friends, thank you all for watching. Until new videos, put likes, subscribe to the channel and to the group in Telegram on the link in the comments. I'll be happy to see everyone again. See you all soon.